Hi, thanks for joining us today. We will be doing a webinar on socially responsible investing, what makes an investment socially responsible. My name is Louis Berger. I am co-founder and principal of Washington Square Capital Management. Before we start, just a little bit of information about us. We are an independent investment advisory firm based in New York. We offer three core services for our clients, both individual and corporate clients. They are investment management, financial planning, and pension benefits consulting. We also offer socially responsible investment portfolios for a number of our clients, both individuals and institutions. So let us move ahead. Let's talk about socially responsible investing and its origins in the U.S. It actually dates back to the Quakers in the 1700s, where they wanted to, when they looked at investing, they wanted to exclude investments in businesses that engage in the slave trade. Also, early history, SRI was through the Methodists who invested in businesses where they wanted to exclude sin-based businesses like gambling and liquor. More recently, in the 20th century, we saw in the 60s and 70s, we saw a lot of investors that wanted to exclude investing in companies that participated in the Vietnam War, so they wanted to exclude war profiteers. And then in the 70s and 80s, we've also seen, we saw institutions like pension funds and universities that wanted to exclude investments in South Africa due to apartheid. More recently, when we look at the 1990s to the present, there's been an increased awareness in environmental issues when we think about climate change and global warming. And also, there's been increased awareness about consumption and population growth and resources, natural resources around the world being overused and a push towards sustainability. So we've seen green investing take shape and become very popular, particularly in recent years. When we talk about socially responsible investing, a lot of people think about the environmental side of it, sustainable investing, and those two terms are often used interchangeably. But really, when we look at SRI, it's a very broad approach, and it actually transcends politics. So when we look at social responsibility, it's a very subjective term. So it means very different things to different people. So if we look at it from a political perspective, when we look on the left side of the political spectrum, some of the values that are used in SRI are, comes with the environment. There's conservation with the environment. There's fair trade considerations, human rights, and workers' rights. So, when a SRI investor looks at, businesses and corporations, they want to see that they take these issues into consideration. So with environmental conservation, they want to see businesses make an effort to reduce their carbon footprint, the resources that they use, and institute practices that will ensure that they follow certain mandates that are set up either by governments or by trade associations. On the right side of the political spectrum, we'll see socially responsible investors that want to invest with values such as pro-life, stem cell research, gun owners' rights, and Christian values. So these investors will want, let's say pro-life, for example, they'll want to invest in, let's say they're going to look at medical companies. They'll want to avoid companies that are actually engaged in providing medical devices that help assist in stem cell research or abortions. And the same thing when it comes to Christian values. There'll be certain values that they'll want preserved in the companies they invest in. They may want to avoid companies that are engaged in pornography or gambling. So when we talk about socially responsible investing, really what it is using an investor essentially incorporating certain values that they have and extending that into their investment decisions and their portfolios. So it's another kind of layer of decision making that goes into the investment process. So instead of just looking at investments from a financial perspective, there are certain prerequisites that will go in to this investor making the decisions that they make. When we look at strategies, when we look at how a socially responsible investor will actually incorporate these values into their investment strategies, there's a few sort of big basic approaches. The first one is positive screening. So positive screening would be taking a view on certain values. Let's say the example I use here is, let's say you're a conservationist, you're sort of pro-environment, and you're interested in companies that are producing goods or services that are helping the world move away from, let's say, fossil fuel-based energy sources. So that person would want to positively screen for alternative energy companies, solar power, for example. So they would look at the investment universe and they'd say, I'd really like to take an investment in a company that's actively moving the world away from fossil fuel-based energy, and they would seek these types of companies. Negative screening is, sort of taking those same values, but actually applying it to the investment universe and excluding certain companies. So using that first example with the environmentalist, they would want to maybe exclude, let's say, a coal company or an oil company or a company that is engaged in using energy sources that are considered to produce a high carbon footprint, or are also considered to create, unfortunately, the types of environmental devastation we've seen. We think of BP as an example, or the Exxon Valdez tragedy, where an investor will say, I want to exclude those types of companies. The other example I use here is let's say a person is anti-war, and they'll want to exclude, let's say, a weapons manufacturer, the type of company that builds bombs or builds fighter planes, the types of businesses where really the main benefit from their business is war. And that's how their products are put into use. The next is best in class, and with best in class, an investor is looking at maybe looking at a negative screen industry, and is actually looking for companies that are thought to be thought leaders and kind of leading the way. So an example would be, let's say, the environmental investor we mentioned earlier on. The best-in-class environmental investor would look at an industry like the oil industry, for example, and pick the company that is, the leader in terms of, their environmental behavior, how they conduct their business practices, and perhaps the types of companies, smaller companies they have within their portfolio of companies. So let's say a big oil producer is taking some of their profits and actually investing it in wind power or solar power or biofuels, and actually doing research and acquiring some smaller firms in this area. A best-in-class investor may look at that company and say, well, they're moving in the right direction, so as an investor, I'd actually like to reward that behavior and invest in that company. The thinking is this behavior is not only good for the environment, but it's also going to be profitable for the company down the line, because as most of us, or all of us hopefully know, fossil fuels are a finite resource and they're not going to be around forever, so eventually we're going to have to move away from that. The next one is shareholder advocacy, and really what that is an investor taking a position in a company, buying stock, and actually using their stake in the company to change corporate behavior. So the way that works is through votes, proxy votes. At annual meetings, an activist shareholder advocacy investor will put forward certain types of legislation to be voted on by the corporation at large. The last type of SRI strategies is community investing, and that's really just looking at communities that may not have access to traditional financing. So let's say poorer inner cities, maybe third world countries, where banks may not go out and lend actively. This is usually done by an institution that wants to provide investment capital for these types of communities. It's also done with microfinancing. So if you've ever heard of Kiva, an individual could participate in this by, let's say, investing or actually providing a loan to a business in a third world country, and the investment pays something back, but really the primary interest is to provide a sort of financial helping hand to a community or an individual or group that needs that help, that boost. So how about some facts about socially responsible investing? It's actually a pretty big part of the investment universe at large. Recent figures, I pulled these from the Social Investment Forum, and their 2010 study looked at $25.2 trillion in the U.S. investment marketplace, and $3 trillion of that is invested with an SRI mandate. So that's actually 1 out of every $8, or about 12% of all investments, and that's growing. Traditionally, the early adopters of SRI have been institutions. So we'll look at some corporations, universities, foundations, pension funds, nonprofit organizations, religious institutions. These have generally been the ones earlier on, and then the larger investors that have participated in having a socially responsible investment mandate in their portfolios. But recently, we've really seen individual investors being the fastest growing segment. And there's been a lot of interest, particularly in recent years, of individual investors wanting their portfolios to reflect their values. So, you think of an example of a person, let's say, who shops at Whole Foods and, buys a hybrid car and fluorescent light bulbs and recycles and composts and really makes an effort, has solar panels on their roof, really makes an effort to integrate social responsibility and environmentalism into every aspect of their life. Well, when they look at their investment portfolios, they want to extend that behavior to that as well. So they'll say, I look at my investment portfolio and I want to invest in the same types of companies that share my values. So that has picked up a lot in recent years, and we've seen the financial services industry respond to that. So when we look at the mutual fund industry, we'll see that back in 1995, there were only really 55 funds offered that had some sort of socially responsible mandate. And as of last year, that's grown to 250. And you can see the amount of money invested in 1995 was $12 billion. And in 2010 was $316 billion, so a huge growth over that period. And with mutual funds, generally that is individual investors. Institutional investors usually invest in separately managed accounts. So when we look at this growth in the mutual fund space, that's really the growth from the individual investor. So moving along with individual